All right, so last topic, long-term notes receivable. Essentially, everything's the same as short-term notes it's receivable, except for obviously, because there's a longer period of time, the time value of money is going to have a much larger effect. And so it really matters, or really starts to play a role when the rate on the note and the market rate of interest are different. And so as soon as you have that kind of situation, that's when that time value of money has a bigger effect. And so in this case, we have a note, long-term note. We made a sale on January 1st, 2021. They agreed to accept a $1.25 million note. It's due in 2 years. And of course, there's a very big difference between the rate on the note and the market rate of interest. So 0% and 12%, clearly not the same thing. It's over 2 years. We need to apply the time value of money. So how do we estimate the cash sales price? So the sales price, if they had paid cash, how do we estimate what that would be? And again, we take that market rate of interest and figure that out. And so the N, of course, is 2 years. The I/Y is 12. There's no payment, recurring payment, but there is a one-time payment at the end. So when we calculate the present value, we get $996,492. And so that is the present value of that note. And hopefully, you know by now, the present value is the sales revenue amount for the sale. And so when we look at that, what goes into it? Again, the initial sales revenue is the present value. The note is issued at the face value. And then the difference, of course, is the discount. What are the things that we're going to have to worry about, though, now that we have a longer term note? And one thing we're going to have to worry about is fiscal year end adjusting entries. So we're going to have to accrue and amortize. So we're going to have to amortize that discount and accrue the interest revenue, even though we're not getting paid anything. We continue to do that. And again, theoretically speaking, you start accruing interest instantly. We're just going to record it periodically. So it's a continuous process where we make periodic adjusting entries. And of course, we do have to record the payment of the note at maturity. All right, so let's record the initial sales revenue, which is going to be the present value, the issuance of the note, and the discount. Again, just reminding us of our information. Hopefully the journal entry is not too bad. We know that the note receivable is the face amount of $1.25 million. We know that the sales revenue is the present value of that note, $996,492. And the discount is the difference, $253,508. So now on 12/31/2021, we need to accrue the interest. So we need to amortize the discount and we need to accrue the interest. And so how much interest do we need to accrue? And the answer is, hopefully not too bad. The key, I think, here is knowing what to start with. And you start with the present value, or it's kind of really think about it as the carrying value of the note. So we always start with whatever the carrying value of the note is. And initially, the carrying value is the present value, $996,492. The interest rate that we're using in the TVM calculation is 12%. And in this case, it's a full year. So we issued the note on January 1st. And so it's a full year's worth of interest. Therefore, we need to accrue $119,579 of interest. And so really the way we're thinking about it is we need to amortize the discount. And from that, we derive the interest revenue. And so we amortize the discount, $119,579. And that results in interest revenue of the same amount. Again, debit and credit. Okay, so now we kind of made this an easy one because it's only a 2-year note. And so then in that second year, really there's really only a few things we have to worry about. I mean, as far as the calculation, it's not too bad, but of course we have the payment. Hopefully that's obvious. But you also now have to record additional interest, right? Because the note continues to accrue interest implicitly, but it continues to accrue interest over that remaining 12 months. And so there's really 2 ways to calculate it. I want to introduce one calculation, which is basically what is going in this box. This box is the updated carrying value of the note. And so when you think about a note, the initial carrying amount was $996,492. And that carrying value, that was the note, the face amount minus, oops, if I can spell. It's a little hard, minus the discount. So initially that that carrying value is always calculated as the face amount minus the discount. So initially, the face amount was 1,250,000, and then the discount was our original balance of, if I go back, 253,508. That was the initial balance. Okay. Now, on this journal entry, notice what happened to the balance in the discount. It was reduced. And so if we kind of apply that, if the discount goes down, then the carrying value goes up. And so that's what we've done, is we've increased the carrying value of the note. And so now with that new carrying value, when I want to record interest, I take the new carrying value, multiply it by the interest rate that we're using and the number of months we're accruing interest, which in this case is another 12 months. And so that's 133,929. Now, because this was a very simple 2-year note, the other thing we could kind of conclude is, well, if I need to record $253,508 of amortization, if that's what I need to record, and I've already recorded 119 and some change, it means that I must now record another 133,929. That is the other way to get to it. But again, I wanted to show you how to do this calculation so you could understand where we could use our equations and our math to get to that same number. Again, if I want to know how much interest to accrue, I have to take the carrying value, multiply it by the APR, and then the number of months out of 12. All right, so now we'll record this. Again, receive the cash payment. We take the note receivable off of our books, and then we amortize the remaining discount balance of 133,929, which results in another year of interest revenue, 133,929. And now we're done with the note. Again, hopefully that's not too bad. All right. Similar to accounts receivable, you can also estimate bad debts for notes receivable. It's kind of the same process, really nothing new there. Again, you got to use that CECL model. It's got to be based on history, current conditions. Any kind of assumptions have to be consistent and have to be defendable. So again, reasonable sorts of ways. And again, when banks do this, especially if you're going to work in a bank, you should be aware when they have those notes outstanding, this is the account they usually use. And so instead of like allowance for bad debt or allowance for uncollectible accounts, with notes, they usually call it allowance for credit losses. That's normally the account that you use. US GAAP does permit you to report notes at their fair value as well. So that is an alternative. So you could, especially if the note is long enough in term, the fair value could change. And so that is, you can do fair value adjustments to your notes as well. But that is it. That is the material for chapter 6. I'm sorry, for chapter 7. Again, we're not going to be talking about financing of receivables and factoring. For those students who are planning on moving forward, especially if you want to sit for the CPA exam, factoring is on the CPA exam. So, I gave you a lot of notes and you can use the book to fill that in. I'm probably not going to really record a lecture on it. At least not this semester. But for those of you that want to continue to learn, the notes are there, but just to be clear, for my class, it's not on the test. So that is it. Hard to believe, but that is intermediate 1 wrapped up, and I will see you guys in class.